Hey guys, welcome back. I believe we've officially reached the psychological breaking point of this AI infrastructure cycle. Was today the turning point? Was it the pivot, as I said in my thumbnail? Did we see the shift that we needed to see with Micron, with the memory sector, with many of the other hardware names that'll show us that confidence is coming back into this sector? Because over the past 2 weeks, a massive wave of profit taking and sentiment fatigue has driven names like Micron down 23% from its absolute peaks. We've seen SanDisk surrender almost 30%. If you open any financial news, if you read any headlines this morning, the mainstream consensus was operating in an absolute echo chamber, all screaming technical bear market, all mentioning that we have reached the top. They're screaming that the hardware trade is officially fallen into this technical bear market, like I said. But I think personally, when I look at all the signals in the market, that we are at a turning point. We are at a pivot where confidence will come back into this sector. And we have a number of different, just highly important catalysts that will happen over the next couple of weeks. We know the SK Hynix, their ADR listing on Friday will test the confidence in investors. But next week, we have over the next 2 weeks, actually, we have massive number of earnings from the hyperscalers. What will that tell us as well? Will that continue to drive momentum into this sector? Will it give confidence that the hyperscalers are going to stay strong with their CapEx, with their build out of this AI infrastructure overall? Will it continue to bolster the confidence of us investors across the memory sector? So this month is going to be critically important for the sector. There's going to be so much for us to talk about together. So make sure, if you haven't done it already, you hit like, you subscribe to the channel. Guys, this is the #1 Micron channel on YouTube, bear none. We have covered this sector since I've launched this channel in January exclusively. There's many other new channels that are jumping in and trying to jump onto this hot trade, this hot sector. But just know, we have covered it together from the beginning. We'll continue to cover it through good days and bad. That's the type of commitment that we'll have together. So let's jump into the video today. There's a few things that I want to cover. There's a couple of articles that jumped out to me that I think just speak to the sentiment of this sector perfectly. So I want to review those together. I also want to just take a look at some fresh perspectives or some strengths for Micron, some pillars that we can build our confidence on. We'll go through that together. We'll take a look at the trading tape. How did the Fab 4, how did the memory titans actually trade in today's market? And then I want to give you some fresh perspectives. I want to show you a few analysts and some of the fresh sentiments or the fresh perspectives that they put out there this morning regarding the sector overall. That's what we'll go through together overall. But again, if you haven't hit it already, make sure you hit like, make sure you subscribe to the channel. Let's start off and take a look at the first article that I want to discuss, because the retail traders, they've been treating this correction like a structural funeral. We have seen it across the board. It is losing momentum. Institutional desks, on the other hand, though, are watching and following closely what Alex Barrow calls the narrative pendulum. So that's the first article that I want to go through. Let me pull that up and we can walk through it together. You can see it actually follows around Qualcomm. You can see it was published here in Yahoo Finance, ultimately from Zacks. But what I want to go through is this piece down here, where it's the narrative pendulum, because this spoke to me. I think this is kind of what we're seeing in the market right now. This concept from this analyst, Alex Barrows, and what he goes through. The basic idea, as he mentioned, is that even when a powerful secular trend remains entirely intact, the market's perception of that trend can swing dramatically between extremes. In the case of AI, investors move from believing the opportunity is nearly unlimited to worrying that the entire build-out is excessive, wasteful, or unlikely to generate adequate returns. He further goes on to say that this is where we are right now. Concerns around overspending, capital misallocation, falling LLM costs, hyperscaler margins, and ultimately return on invested capital are beginning to weigh on the AI trade. These concerns are not necessarily fatal to the long-term thesis. In fact, they are probably healthy. Periods of doubt help cool the kind of speculative enthusiasm that can drive prices almost straight higher and create a more durable base for the next leg of the cycle. I continue to believe that the AI boom has room to run, but a pause or correction here would not be surprising. So that kind of jumped out to me, that article, for that first one. I think that's just kind of this natural pendulum swing that he was talking about is what we have seen in the market. There's no question around it. We've seen this underlying reality of advanced data center expansion and how that just moves in a steady compounding forward line. But the market's perception of that line swings like a wild pendulum between two irrational extremes. That's what we've seen in the market probably over the last couple months. We've seen this mindless parabolic euphoria, and now we're kind of seeing this blind catastrophic panic. Yesterday, we saw that pendulum. It slammed directly into the panic wall on the fears that memory cycle was peaking. So let's jump into the second article, because this one I read this morning when I woke up, and it definitely rang true to me. Let's see what you guys think as well. So let's walk through that piece together. And this article has an interesting title. You can see it's called Memory's Old Ghosts Meet the AI Gold Rush. Essentially, this kind of battle of the cyclical past versus the new infrastructure, being the new AI toll booth infrastructure, or kind of the epicenter of the build out. So let's walk through that article. He says right here, old ghosts. Memory chips have always been the market's most glamorous steel mill, brilliant at the top, brutal at the bottom, and forever trying to convince investors that this time the furnace will not cool. That sounds exactly like the sentiment that we're feeling in the market. We see that Michael Burry put out a short position, basically saying, remember, this sector is cyclical. He is trying to bring past the old ghosts, trying to cause a bit of fear and anxiety in the minds of investors. But guys, I fundamentally believe that the sector has fundamentally changed. We have gone through a structural super cycle. It is not the sector of the past. He goes on to further say here that on the surface, the story looks almost too good to challenge. AI demand has turned high bandwidth memory into new strategic ore of the digital economy. SK Hynix, Micron, Samsung sit on an oligopoly at the very moment that hyperscalers are scrambling for supply. Margins are fat, pricing is firm, and the industry has the kind of customer desperation every commodity producer dreams about. But memory, he says, always had a cruel habit of making geniuses at the top and ghosts at the bottom. This is why investors have started to look past record earnings and ask whether the structure has really changed. That's the doubt we see in the market right there. It's funny. As much as the revenue that we have seen from these companies, how high they've reached, the margins that Micron is reaching, 84, 85, 86% margin for them, for a hardware company, the revenue that they're driving, the forward guidance, we still have a large number of people asking the same question, just afraid to let go of the past overall. And that's where the long-term agreements become the industry's attempt to turn a roller coaster into a toll road. So Micron has shown the blueprint. 5-year customer agreements, cash deposits to secure supply, price bands with ceilings linked to prevailing market prices, and floors that still protect the unusual high margins. In plain language, he goes on to say, they are basically writing covered calls on the boom to buy insurance against the bust. And that may be the closest thing that memory has to a super cycle argument. If customers are desperate enough to prepay, and if those prepayments make it costly enough to walk away when the cycle turns, then the old spot market trap becomes less deadly. But in semis, there is no free lunch. And this is an important piece because we'll get to it later in the video. So I just want you to hear it now and just think about it as we get into the later piece. It says the more downside protection that Micron, SK Hynix, and others lock in, the more upside they likely surrender. And that matters because the current profit surge is not being driven by explosive volume growth alone. Micron's DRAM shipments rose only in low single digits in the last quarter, while average selling prices jumped more than 60%. In other words, the magic is still in the pricing. It's the pricing power these manufacturers have in the market. But here's the kick. Give away too much of that upside, and investors may start asking whether the companies have swapped a rocket ship for an annuity. The other risk is contract timing. If the agreements mature at the same time, the industry could create its own version of a patent cliff. One day the floors are there, the next day the market is back in the wild. Staggering those agreements will matter as much as signing. Like I said, I love this article. I think it just really speaks to what we see in the market today. It says that memory makers do not need to prove that they can print more money during a shortage. They have done that before. They need to prove that they can keep printing acceptable returns when the shortages fade. When customers regain bargaining power and when the next wave of capacity comes over the hill. So yes, the circle can be bent, but broken, not yet. That's a key piece too that he mentions. He says, for now, memory remains a cyclical animal wearing an AI crown. The contracts may tame the beast, but they may not have domesticated it. That's why SK Hynix New York debut is just another victory lap for the AI trade. It's a public audition for the idea that this time the industry can keep playing the music after the boom stops shouting. So I thought that article was just so perfect for the time that we see right now in the marketplace. The market is confused because it is haunted by the ghost of old cycles, but the underlying corporate behavior, it has changed. And that's what I think most people are struggling with in the market right now. Investors are demanding proof that elevated pricing can be sustained for years without demand suffering. And the industry's response to that anxiety is completely unprecedented. The unprecedented piece brings us directly to the ultimate fundamental weapon against the bear thesis, the structural shift of long-term agreements. To tame the violent swings of old semiconductor cycles, memory makers have introduced a brilliant new corporate blueprint. They are locking customers into multi-year agreements that require cash deposits to secure physical supply, combined with strict pricing bands that feature absolute pricing floors. Why would a hyperscaler voluntarily give up pricing flexibility? Because securing supply has become more valuable than negotiating price. Let me show you that article. You can see in a world where memory is no longer a commodity, but a strategic, valuable asset, customers are eager to sign long-term supply agreements. And we know from their earnings that Micron, the company, they have about $100 billion of guaranteed baseline revenue already locked in under 14 of these 16 strategic agreements. So that's just massive kind of revenue visibility that we see from Micron going out to 2030 overall. Those are the hard numbers, guys. Micron has quietly secured roughly $100 billion in these long-term customer agreements, selling out advanced capacity well into 2030. Think about the immense visibility that gives this company. While retail traders have been dumping shares because Micron over the last 2 weeks has shown a technical pullback, the business has secured a literal fortress of contracted, de-risked revenue. Now, to remain a balanced analyst overall, I do want to call us back to the article that we just talked about a few moments ago around the ghosts of the past, because it is a definite structural trade-off. As that article mentioned, the more downside protection that Micron and its peers lock into these price floors, the more explosive upside pricing torque that they surrender to their customers. If they give away too much upside, growth investors might eventually cap the valuation multiple they are willing to pay. Furthermore, if these contracts mature or expire around the same timeline, it creates this artificial patent cliff down the road. But for the next 24 to 36 months, this $100 billion cushion for Micron completely shatters the argument that earnings are just going to vanish overnight. Now, notice something fascinating here, though. The debate on Wall Street right now is no longer about whether AI needs more memory. Everyone agrees that it does. The debate has shifted to something entirely different. The debate now is whether memory companies can sustain pricing power long enough for investors to justify today's valuation multiples. That is literally the debate that we see in the market right now. So now let's pull back the curtain on the actual trading mechanics and read from the tape today. Look at the tape from today's session, because this is where that narrative pendulum meets raw technical physics. Let me pull up the what we saw on the 5-minute candle for trading view. You can see it on your screen. If you look at this 5-minute candle chart for Micron, you can see exactly what we saw across the day. At the opening bell, we witnessed today total capitulation. Panic from the overnight international sessions. It triggered automated stop losses, automated selling, and you see Micron slammed all the way down to a brutal intraday level as low. It got down to about 900 overall. But look what happened the moment that it touched that level. A massive institutional volume spike arrived. Smart money recognized that a stock that has been up over 650% in the last 12 months had just been served up at a historic technical discount. They aggressively bought the dip. Look at the structural recovery over the 5-minute candles that you see. Look after that, and we see this nice kind of pattern of just higher lows. We got into this ascending higher low pattern, ultimately closing the regular session up over $10, about $10.42, just over 1%, and Micron closed at just about $949 a share. It completely battled back from the brink of that sub 900 breakdown to reclaim its short-term bullish momentum. When you want to see something even more impressive, let's pull it over, and you can see what Micron is doing at 949 you see. But if you look in the after hours, still putting on a little bit more, about $4 and change there. But I want to show you what we saw across the sector overall, because not only did we see with the memory, but as I scroll down here, and let me just show you, Broadcom had a great day, right? $18 up, almost 5% up, all based on the news with Apple that came out. But take a look at SanDisk. SanDisk up over $111 today, almost 7%. After hours adding a little more. Western Digital up over $18. We saw our optical players, Coherent up. Lam is up over 2%. Applied Materials up almost 3%. There's Seagate up over almost 4% as well. So what we saw across the board today, guys, was just hardware moving. We saw capital rotating back into it. The intraday price action today from Micron, it completely unmasks the bears. Short-term retail fear can drive transient price swings, but institutional capital is heavily refortifying this physical layer. As the market strategist noted this afternoon, a powerful mix of oversold technical conditions and aggressive dip buying proves that the incentive is very high to acquire these high conviction stocks as the prices fall. It's immense in the market right now. That's what they called out in today's action overall that we saw. So where does the dust actually settle here? What we are looking at is the absolute definition of institutional re-rating in real time. The bears want you to believe that this 20% pullback is the first domino falling in a brutal, old school commodity crash. But the tape is telling us a completely different story. This isn't a cyclical collapse. It's a massive structural pivot. The biggest mistake investors can make is confusing price discovery with the deterioration of business fundamentals overall. Over the last 2 weeks, Wall Street repriced expectations. It did not reprice the physics. Memory hasn't become less essential. It's just become more expensive. And that's exactly why the debate exists today in the market. But I want you to hear from some fresh perspectives from analysts as well. So let me pull that up, and I can show you a few that hit the tape today.
Gives me comfort. I acknowledge the technicals don't look good. Is the fundamentals of this story.
Can I see the year to date, please? Thank you.
Technicals.
Go ahead.
Yeah.
Sorry.
Trading at 6 times forward earnings, as I see earnings estimates doing nothing but going up. We've talked at length about the strategic supply agreements, which to me are going to elongate this cycle. And then on top of it, very soon they're going to start returning cash to shareholders in the form of share buybacks. All of these things come together to create a very positive fundamental picture for them.
That was Jim Liebenthal talking about how he's doubled his Micron position. But I also want to call out a couple others that hit the tape today too. So let me pull up this one first. You can see here on Zacks. Zacks goes through essentially a case for Micron. At the end, it says, buy Micron stock hand over fist. Micron's fundamentals remain intact despite the recent pullback. Its revenue growth remains strong. Margins expanded. Increasing AI-driven memory demand has strengthened its growth outlook, making the recent weakness an attractive buying opportunity. They forecast the average short-term price target for Micron to be about $14.22, implying almost a 45% increase from the last closing price of where we stand today. The highest target is $2,000, suggesting a potential upside of over 100%. Micron, therefore, is Zacks' #1 pick. Strong buy. Now, I want to talk about that 2,000 price target because it's actually not the highest. What we saw today is Ben Reitz from Melius Research, a 4.7-star analyst, actually put a 2,200 price target for Micron on the street. This would carry a roughly $2.5 trillion market value for Micron if it hit this price level. It would make it the sixth highest company in the U.S., ahead of TSMC, ahead of Broadcom. And what's interesting is Ben is raised his price target 3 times in the last 2 months. He opened his position, as you can see, in April with a $700 price target. In May, he jumped to $1,100. And in June, he's up to a $2,200, the street's highest right now. So guys, those are a couple pieces of that I just wanted to show you, kind of just to confirm the strength overall. And let me pull back up, because one thing I always look at just quickly to show you is just where we sit with the analysts. As you know, but I want you to look at this. The average price target for Micron is almost 1,500, 56% upside from where the stock is trading today. So I just wanted to give you that level of confidence for the analysts, what they see in the market, because what I said yesterday, I want to repeat. Do not confuse this near-term mechanical liquidity flush with a long-term structural reversal. The smartest money in the world, as you just saw from those analysts, they are using this transition into a so-called technical bear market to buy premium assets at a deep institutional discount. So guys, that's the setup for today. I hope you enjoyed the video. Drop your comments below. Let me know your thoughts. And as always, make sure you hit that like button and subscribe to the channel so you can track this sector with me each and every day. See you guys tomorrow after the closing bell.